Good morning and welcome to the first session on Chapter 8, National Income Accounting. This is a very important chapter in economics where we are going to understand the concepts of final goods, consumption goods, capital goods, and the various types of investments that are being done in the Indian economy. Now, national income accounting, as the word itself says, it deals with accounting of expenditure and revenue. So we are going to learn the ways and methods through which the GDP is being calculated, the expenditures are being calculated, how the revenue is taken into account, and what are the various methods that is going to be involved or that is being practiced in the Indian economy in order to achieve a good GDP growth altogether. So moving forward, we are going to talk with the beginning of final goods, consumption goods, capital goods, and intermediate goods. Now, what are these different types of goods? We have heard about in economics there is one good. There is a product which is a finished good altogether. But what are this classification of goods altogether? Now, if you look into the economy, there are various types of production process that gets involved. It might start with a small scale industry and it might go to a very large scale industry altogether. But in every production process, there are some steps involved and there are certain methods that produce different varieties of good. So keeping that in mind, we are now going to look into the various types of good, namely the final goods, the consumption goods, the capital goods, and the intermediate goods. Now, what do you mean by a final good? When the word final is being told in economics, that means it is that good that is available for the consumer to consume, which means that is the last and the final product, the product which is completely taken shape. This is the product that is going to be made available for the consumer in the market. So that is what we call it as the final good. This is the good that is being produced, packed, branded, labeled with the nice price tag, and it's available in the retail for the consumer to take over. Now, the consumption goods, all the goods that are consumed by the consumers. It might be a fast moving consumer good, it might be an automobile, it might be chemicals, whatever might be the factor. The goods that are consumed by the consumer, utilized by the consumers, used by the consumers are known as consumption goods. Similarly, what is the capital good? Capital goods are the goods, or rather they are the factors which are used as an investment point altogether. Now, if I want to manufacture a pen or if I want to manufacture a toothpaste, I need money. For that factor, we bring in the capital goods. So capital goods are primarily the investment factor that is being invested in the form of material, in the form of machinery, in the form of some component or factor that is used to manufacture the final good. So capital good is the form of input that we need to understand when it comes to national income accounting. So using the capital good, I will be able to produce my final good. Next, intermediate goods. These are in between goods. So this word is very important for us. When I say the word intermediate, that means in between. There are some goods, there are some factors where you will see that there is a raw material, then there is something called as processed good, and then comes the final good. So the stage between the raw material and the final good is known as the intermediate goods. So the intermediate goods will act as a factor, will act as an input for the final good. They pass through various stages of production. So intermediate goods is also a very important concept when it comes to national income accounting. Now moving forward, stocks and flows. This is a very important and interesting concept when it comes to economics. What do you mean by stock? The word stock itself defines that there are certain factors, like you might see that the stock is defined as a material input. The stock might be defined as the factor at a given point of time. So here, when you look into the picture, you will be able to understand the definition. It is defined at a particular point of time. So at a given point of time, let's say in the month of July, in the month of June, in the month of December, what is the stock level the company has? So that can be defined by stock, which means to say your accumulated inventory altogether. So what is the inventory that you have there? What is the amount of stock that you have kept at that particular point of position? Now the company might say that I have 10,000 worth material, I have 20,000 worth material. So stocks are defined at a particular point of time. The second factor, flows are defined over a period of time, which means to say that as the time moves over a period of time. So that's where the example, the pictorial definition itself says it is like a tap from which the water starts flowing. Now until the tap is closed, the water will not flow, but moment you open the tap, the water will start flowing. So we allow the water to flow for a particular amount of time. So similarly, in economics, the flow of money over a period of time is what we define as flow. So now what you see here is that the money or the revenue or the income that flows through the company over a period of time is defined as flow. Moving forward, gross investment and depreciation. Why is this factor important for us? We know that for any investment that is being made in our life, there is a depreciating factor. Now for example, you buy a car today for 10 lakh rupees. Now will the price of the car be the same even after 2 years, 3 years or 5 years? Definitely not. The price would have come on a decreasing mode and it would have become 3 lakhs, or even worse, it would have become a 2 lakhs altogether. Now why is this depreciation coming into picture? The reason is that there is something called as usage value. Now what is this usage value altogether? The consumer will tend to use the particular product or the particular item for over a period of time. As you start using the materials, as you start using the machinery, as you start using the components, it will start degrading, it will start coming down. So once that value starts coming down, the financial value of the product will also start coming down. So that's very, very important that we understand the concept of depreciation. Now what is a gross investment? Gross investment is actually an amount that is being thought about. It is not invested. That is where we need to understand this point clearly. It is not yet invested. It is a thought process. I have decided that I will invest 1 crore rupees in Tata Motors, or I might have thought that I want to invest 1 crore rupees in some steel company, but I am not yet invested. It's a gross investment. It's just a thought process. So, but my ideology of investing that money will come after certain period of calculation. So the net money, the money that which will actually I will invest into the company will be the net investment. So gross investment is about the thought process. It's about the idea that company makes in its mind how much we need to invest over a period of time. And the depreciation is a factor that you will start seeing which starts deviating downwards because of the usage value of the product. So these are the differences between gross investment and depreciation altogether. Moving forward, we are now going to talk about accounting for expenditure. Now coming into economics, for a while, when we start thinking about a country like India, which has got about 135 crore population, and this is a big number for us to think about. How can the government go ahead and satisfy all the members of the country, all the citizens of the country? How can the government be able to manage the expenditure for such a large country, for the world's second largest populated country? So that is where the accounting for expenditure starts coming into picture. Why this is very, very important? Every time the government will decide that they have to spend an X amount of money for some development and welfare of the people. Now that development and welfare will come across in different forms and factor. Now it might be about where we are talking in terms of physical growth, or it might be in terms of education, it might be in terms of healthcare, it might be in terms of infrastructure. There are so many factors altogether. But for every single expenditure, the government has to account for it. Why? Because it is public money. It is the money that is collected from the people and diverted back to the people for their benefit. So you cannot go ahead and say that I have spent 1,000 crores today on railways. Now when you say that you have invested 1,000 crores on railways as a mode of transportation, you should be able to justify to the people and to the various government authorities saying that why that amount was invested. So it becomes very, very important for all of us to think and then get into the expenditure mode. Now the entire expenditure of the government is taken care through the fiscal policy. This is very, very important word altogether. It is not physical, it's fiscal policy. Fiscal stands for expenditure. So when you go through the fiscal policy of India, they will write down each and every expenditure, which I mean to say they will account for it. Putting on to the different columns and subheadings, they will definitely tell you where exactly each and every rupee of the government of India has gone into. And we need to write down this expenditure so that we shall be able to calculate, analyze where exactly we need to spend for the growth of the country. So accounting for expenditure is very, very important. The more the expenses, the more we need to calculate and we need to analyze. Why? Because the money factor is very, very important for a country like India. The higher the expenditure, the outcome also needs to be on the higher end. So accounting for expenditure becomes a very, very important factor for every single government that needs to be presented to its citizens. Moving forward, the circular flow of income. This is a very, very interesting concept. Most of the time, we find it very interesting, or we find it rather a puzzling question altogether. Where is money created and where does the money go? Now everybody knows that RBI prints the money, and then where does the money go? Now the answer to that is the circular flow of income. Now the companies, household, government and the various other sectors will keep on playing around in terms of the circular flow of income, which means to say that money does not stay at a particular point altogether. The money gets rotated among these people, among these factors, firms, households, factory payments, services and spending altogether. Now how does this happen? Let me give you a simple example. Now there is a company like Colgate which manufactures toothpaste for dental healthcare. Now what happens is that when they produce that toothpaste and it goes to the market, there is a household which will buy that toothpaste for 10 or for 20 rupees. So when the manufacturer manufactures a particular component and the household buys it, so the money starts moving from the household to the firm. So there is a payment that moves from the household to the firm. Now the firm, after collecting the money, it becomes a revenue for them. So for the revenue they have earned, they need to pay a tax. So now the money that has been earned by the company shall be paid back to the government. A part of it shall be paid back to the government in the form of tax. So you will see that taxes comes into picture, and that's where government becomes a monitoring agency. So they take care of the tax. Now government will take that money and again circulate it back in the economy for the benefit of the household, for the benefit of the society, for the benefit of the companies and organization. Now for every single government purchase or for every single government selling of assets or liabilities, automatically there are some factor payments and services, which means there are some taxes, there are some formalities that needs to be taken care in terms of payments and services. So that is where what happens is that when you talk about the word payment, that means we are paying in form of some taxes, services, which the government will get revenue from that. So automatically the money is always getting circulated. It is balanced from the household to the company to the government to the factor payments and services, and this concept promotes the spending concept, which means to say that consumption in economy starts because of circular flow of income. If this flow is affected somewhere, if you are able to see that in the current scenario, when people do not have enough cash to spend money, automatically the circular flow starts coming down. So it is very, very important for the government to see and think that they need to maintain the consumption ratios. They need to push forward the consumption. Only on higher consumption and higher demand, there will be a circular flow of income. If there is no flow of income inside the economy, then none of us can get benefited. It is not that you get the money and you just keep it in your pocket. It is that you need to take the money, you have to spend it. Because of your expenditure, some other will get benefited, and it keeps on moving. This is a chain reaction altogether. So when we talk about the concept of circular flow of economy itself, it's very, very important that we keep the consumption cycle intact. So that is how we are throwing importance in terms of understanding the circular flow of income. So higher the circular flow of income, higher the consumption, higher the demand, that automatically will boost our GDP altogether. With this, I would like to come to the conclusion of today's session. Thank you for joining me today on this wonderful session. I hope and believe the session was educative and informative. Please stay tuned, stay blessed, and stay enlightened for the next session on Chapter 8, National Income Accounting, where we shall be discussing about the different methods of calculating the GDP. Until then, thank you and goodbye.